Hello traders, and it's Tirun Opan here from the Master Markets Illustrious Conference and Traders Open Day. We are actually sitting in that room with that guy who showed you all the charts of price bars, and you're in DBS and you got to meet that guy and he triggered your interest with his red Jaguar, and then now you are here today, in trading. And
Well, that's right, yeah. And when I gave up my job, I was head of research at De Beers, and when I gave up my job to trade full time, my poor mother had a heart attack. We had to hospitalize her. She she was very upset that I gave up a really really good job to, in fact, become a full time trader. And clearly it's difficult. I don't care how long you've been trading. When you start to trade and you haven't got a full-time income, it puts a great deal of pressure. Many of the people listening will have read Reminiscences of a Stock Operator, and folks, if you're listening and you
yes, yes,
haven't,
yes.
you need to find a copy of it.
It's a really good book, a very good book.
Old Livermore himself wanted to buy his wife a fur coat, and in one of the chapters he traded for many many months on end, and he still couldn't afford the price of the fur coat. And he said that if you need a coat badly, the stock market won't give it to you. Okay, so scared money is quite difficult. It takes a while to get over that, and I know many people who've never been able to get over that. They trade really really well when they've got an income, and when that's solid income or guaranteed income goes away, then they start to do stupid things. And I can understand that. Not easy at all. Took me a while to get used to it.
Makes sense. I guess it just takes a while for the mind to get in gear. I think we've all gone through that. We can totally relate to what you're saying.
Yes, it requires what I call testicular fortitude.
All right, nice way of
Yes.
putting it. Now,
Testicular
going on into
fortitude.
the just a little bit more technical questions before we go onto the screens, if we may. So the first question to start off that I just want to ask you, what is your main style of trading? Like, are you a swing trader, scalp trader, position trader? Do you mainly do intraday trading? What is
Oh,
it?
I've been a swing trader most of my life, but I still do some intraday trading. I was yesterday afternoon, for example, on the Dow, what the local spread bettors in London call Wall Street. I had three trades, and so I don't intraday trade every day, but some days I will in the afternoon, mostly in the Dow in the afternoon. It opens at 2:30 here in the UK. And if I see an opportunity, I'll certainly trade that in the afternoon. But my main style of investing and trading is as a swing trader. And I have a slide prepared that will show everybody in a second what I actually do and the philosophy behind what I try and do. It's actually quite simple. I have four rules that I do my best to put into practice. The Vectivest people, I see quite a few of them in the room, will have heard them. I do a weekly webcast to everybody, and I do my best to try and reinforce that thinking every Monday afternoon. Whether you're trading in the stock market, whether you're trading in forex, we only can make money by finding some form of a trend and then doing our best to finesse an elegant entry into that trend where the risk is least and the reward is most. And that's what I specialize in doing. So
Brilliant.
I am a trend follower. I look for trends, but I'm very careful about entry points because I like to get in at what I call the danger point, where, as I say, the risk is small and the reward is huge. And in this journey over the since 1982, without a doubt, the most important thing to our profitability, in my humble opinion anyway, is to try and maximize that risk to reward ratio, more correctly reward to risk ratio. But on a trading floor, it's called risk to reward. If you called it reward to risk, they would think you were a child of a lesser god. So try to push that up as high as possible. Most of us, I don't care how long we've been at this, find it quite difficult to put into practice a low hit rate system. If you're only right 5 times out of 10, which is common in a trend following system, that means that in the probability of having 2 bad ones in a row is a half times a half.
Yes.
Probability of having 5 bad ones in a row is a half times a half times a half times a half times a half, which is 1 over 32. And that means that in a trend following system, and a trend following system, if you're right 5 times out of 10, you're doing well. You can have 5 losers in a row every 32 trades. And you have to say to yourself, how good would you be at focusing on perfect execution of your rules after 5 losers in a row? And that's the challenge for most people. In my trading seminars, I spend a very long time talking about clustering. And those clusters are real, folks. If you don't believe those clusters exist, just as I say, have a little go at it. The clusters
we definitely agree with you on that, David. We've definitely experienced, all of us have. Yeah, carry on, yes.
Good clusters of good trades and bad trades. And the first thing is to get over the clusters mathematically, i.e. don't go broke in them, which means the old story of risking 1 or 2% in any one trade. And then, of course, the other thing is to be able to handle the clusters emotionally, so that you don't fall apart after 2 or 3 losers. And that takes, as I say, a great deal of testicular fortitude to do that. So the clusters make this game hell. And that's why the stock market's a lot easier, because by only applying what I do to shares with outstanding fundamentals, when the overall market is rising, I can push that hit rate up significantly from the 50%. And when the hit rate rises, then the clusters, the probability of a run of bad ones disappears. It's still there, but it doesn't happen nearly as often, which means emotionally it's much, much easier to trade. So the first
Absolutely,
thing,
David. Yeah, the most important thing is the emotional part, isn't it, for you to move forward with it?
Yeah, that's for sure. That is for sure.
Just a very quick questions before we go on the screen. Just so need to pace ourselves properly, because I think the time as well. Just a quick thing, like just some quick questions, maybe some quick answers would be great before we go on the screens. And I'm sure you're going to go in detail about your strategies. Just on entry itself, is there like a concept that you have to all your trade setups that you take?
Yes. Is that short enough?
Maybe a little bit more, a few months more. I'm sure you explain more in detail later on. But anyway,
I will, but it's something that I can explain very, very easily in a slide.
Okay, never mind. So we'll leave it to later.
I'm going to faff to actually explain it without. And those of you that have come to my seminars will know that I normally sketch everything up on a flip chart so everybody can see it while I'm speaking. There's nothing complicated about it, but it's difficult to do, and that is one of the characteristics of a good trade, which I'll talk about in a second.
Okay, no problems. Yeah, I think the next one is similar to that, so I guess you will explain that. I was asking more like, what does your typical trade entry look like? So you will show that anyway, right? On your slides,
sure,
anyway.
Without a doubt. Yeah.
Okay. Do you scale into trades?
Yep.
Yes, you do. Okay. And what is your best trade to date so far? And what was your thinking behind the entry?
Well, the entry is always the same. The entry is always the same. And I think that one of the things that you have to really do your best, it's one of the biggest behavioral investing mistakes. And that's all about separating the process from the result. Now, if I stand up at a seminar and I ask that question you've just asked me, invariably everybody will tell about the trade that made them the most money. And if I ask them, what was your worst trade in the last 3 months, they'll tell me all about the trade that in fact they lost the most money. But it's so easy to actually mistake the process and the result, because let's face it, if you were short the stock market in February, it was just pure luck of the coronavirus that you in fact made a heap of money. So there's a great deal of luck required as well. What was my best trade? Well, the right answer to that is the best trade is the trade that I've made by following my rules perfectly. And I've got an example of one of those that I'll show you in a few minutes. I've made my best trade ever was in copper, and
Copper.
that was pure fluke, because what happened was that I was in South Africa, and I was long of the copper market, and the copper market dipped, and I was sure I'd been stopped out, and I came to London for the summer. That was, it's years ago, and I came to London for the summer, and the broker, I can't name the broker. He's a London spread betting company. The only thing I can say about them is that their adverts are red. So maybe somebody will get an idea who they were. But I went to see the broker, and they invited me for a big, in those days, boozy lunches were quite common.
Mm-hmm.
So we went for a long lunch, and they talked about this wonderful trade that I'd had in copper. And I said, well, I got stopped out of that trade months ago. And they said, no, you weren't. So I'd missed the stop by a tick. And what happened is that copper had gone into this huge trend.
Oh, wow.
And there was a massive amount of money sitting in the account that I knew nothing about. So that was, in terms of financial rewards, that was the best trade. And that's a long time ago. That was in 1999. I just remember now. That was in 1999 that happened. So in terms of cash, that was the best trade that I've ever made. But in terms of following the process, it in fact was a lousy trade. It was just a pure fluke. Okay, so one thing that I would like to advise everybody listening is that keep a trading journal. In that journal, do your best to try and differentiate between the process and the result, because many of the results that you think are favorable and get you all excited, in fact, occurred just by pure luck. Just by pure luck.
Spot on, David. I think it's the same mantra that we keep singing to all our clients too,
Okay.
which is separate the process from the result, but it takes some time for the mind to get accustomed to. But absolutely right stuff over there. And it's really great to see your input on the best trade, because most people would just say the best trade is the largest profit. In fact, actually, the best trade is the one that taught you the most, or like you say, the one where you just consistently executed the plan to the T and you saw the shift in your mindset. So really good for that insight that you shared.
Yeah, and I think that many of us are perfectionists as well. Many people come from the professions, for example.
Spot on, yes.
And they move into trading, and those, to be successful, and this is based on many, many years worth of experience of looking at retail traders, you need to, in my humble opinion, refocus that perfection into execution rather than the result. And if you focus your perfectionism into executing your simple set of rules over and over and over again, then the lift will take care of itself. So get really excited and get really worked up by following your rules to the tick, and keeping a careful journal. Those of you that would like a book on journaling, there's a beautiful book written by a lady called Julia Cameron on journaling. It's called The Artist's Way. In fact, she's just written quite a few books, so I think you would find that very good reading, anybody.
Okay, that's really good, Julia Cameron. Yeah, that's something that we can put into our trading library. Quick questions on stop losses. Do you use stops?
Yes.
Okay, great. I'm sure you're going to show us where you're going to use them and all that, right?
Yeah, I believe in tight stops, and the stop loss should be well out of the traffic, but it should be tight. And that's why, to do that, then your entry point needs to be brave at that danger point. So
very good point. Yes.
So you can both have you can have a stop that's relatively tight, and you can also have a stop that's well out of the traffic. When you actually have too much confirmation, then the stop has to be well out of the traffic, plus the amount of dollars or pips or whatever you're trading that has taken for the confirmation. So your stop has to, so the more confirmation you have to get away with the trade, your stop has got to be much, 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 much bigger. And because as sure as shooting, if you wait for the confirmation, a couple of bars, for example, before getting in. When you do get in, as sure as shooting, the damn thing will go right back, nail the lows, and then turn again. Has that ever happened to anybody else? So it requires a great deal of strength to get in at the right level and still to have the stop loss small and out of the traffic. And again, that testicular fortitude is required
Okay, great stuff.
in
Yeah.
big lumps.
I agree. I agree. Comes with time. I'm guessing you're going to show us all of that. How do you usually trail your stops, David? Is it a time stop, money stop, technical stop? Is it a combination?
Technical stops
Technical stop mainly.
based on the chart, based on the chart pattern. I want to risk half to 1%, and on the initial position, and I'll show you how I manage those in a minute.
So your risk manager is mainly based on percentage, right?
Yeah, that's right. I would 1% of the account in any one trade, and maximum, and then work out where the stop loss needs to be so that it's well out of the traffic, and then work out the bet size or the number of shares that I can buy so that if the damn thing falls apart, then I've lost 1% or less on my account, and then I move to the next one. I think that you can get away with 2%, but if you have a string of 5 bad ones, and you're risking 2%, and then you're down 10%, and you've got to say to yourself, can you come back from being down 10% without in fact doing something stupid? Certainly if you're working at a fund and you're down 10%, the risk manager will be giving you very long looks. He'll be saying, have we got a loose cannon on our hand here?
Yeah.
So he'll be giving you some very, very long looks indeed. And you could find yourself in the back office stamping, or metaphorically stamping, share certificates, so that you don't want to go there. The trading floor, they have their Christmas party in Barbados. The middle office go to a hotel on Park Lane. And the back office, they have their Christmas party in front of a karaoke machine at Pizza Express. You just don't want to go to the back office, you know. So drawdown is difficult. And if you work for a fund and you start to run into 8 to 10% drawdown, then you're going to actually attract attention. So I would have thought at the institutional level, many traders are looking at 1/3% in any one trade. If they have 5 or 6 bad ones in a row, depending on their trading style, then that keeps that drawdown down. Some of the independent funds that don't, where they have managers that understand drawdown, run much higher levels of drawdown. And there are some books on trend following. There's a little book called The Little Book of Trend Following, and one of the guys in there says that in a pure trend following system, if you get a 50% return, expect to get a 50% drawdown during the same year. And that just would not be acceptable if you were managing client funds. That just would not be acceptable. All your clients would run for the door, okay? So drawdown is hell. It causes you to do really, really simple things. So if you can't handle a 10% drawdown, then you need to be risking much less than 2% in any one trade.
I totally agree with you. That's the thing that hits the psychology. If there's one trade that taught you the biggest lesson, what would it be, David?
Well, in 2004, in 1984, I had made quite a bit of money. In fact, quite a bit of money for my age, and I'd been in the markets at that stage about 2 or 3 years. And then in 1984, I got attached to one share on the Johannesburg Stock Exchange. I was sure it was going to go up, and I added to losers, and I gave back half the money that I'd made. And I had to, in fact, I remember vividly going outside Johannesburg, the South Africans will know a place called Magaliesberg. And I sat on a mountain out there and I meditated to make sure I would never do that again. So I
Oh,
think
wow.
the biggest takeaway from that, folks, is that never add to losers. Simple as that. Never add to
Well,
losers.
that was very nice. Very, very, very good lesson to learn from.